Hi, my name is Alan from Alan Property. Welcome back to my YouTube channel. Today, I'm going to discuss how high interest rate will affect three types of home buyers. The first type will be home buyers who own a single property, especially those with dual income, will be the least affected. The second type of home buyers is those who own a single property but take a maximum housing loan with an unstable income. The third group is those who own multiple properties and with an unstable income, which will be the most severely affected. By the way, please stay until the end of this video as I have a bonus tips to manage your housing loan if your loan contract is going to expire soon. Let us jump straight into it. The Federal Reserve, or the Central Bank of the United States, has been increasing interest rate to tame the sky-high inflation seen in most economies. Interest rate hikes are known as the central bank major tool to lower inflation, which it does by raising the cost of borrowing money to curb the demand for goods and services. This is especially so after the pandemic when people start to spend money and push up inflation. In today's discussion, I will use DBS mortgage rate as DBS has been a trendsetter in the housing loan market in Singapore. A quick look into mortgage rate today, and we will be looking at easily 4.25% for 3 years fixed mortgage loan with DBS as per the recording of this video. It's so ironic that just 2 years ago, most banks are offering interest rate of around 1.3% for a 2 years fixed rate mortgage loan. Let's discuss what if the interest rate if you are a homeowner 2 years ago. Assuming you have secured a housing loan of $1 million for the 25 years loan tenure at 1.3% interest rate. Your monthly repayment will be $3,900 per month. The interest payable for the entire loan period will be $172,000. This means you will be paying 17% more for interest over the entire loan duration. If you are a homeowner today, your housing loan of $1 million for the 25 years loan tenure will be at an interest rate of 4.25%. Your monthly repayment will be $5,400 per month. The interest payable for the entire loan period will be $625,000. This means you will be paying a cool 62% more for interest over the entire loan duration. Here, can you see the scary thing that interest rate can do to your finance? A quick recap. A 1.3% interest rate means that your monthly repayment is $3,900 per month. If you refinance to a 4.25% fixed rate today, means your monthly repayment will be $5,400 per month. This means you need to pay the bank an extra $1,500 every month in additional interest. So don't underestimate what interest rate can do. It may seem a few percent increase, but it can definitely create chaos in your finance. In short, you have to pay more interest to the bank over the duration of your loan. At the same time, if you are renting out your property, the rental yield has to be more than 4.25% to make up the difference in your monthly installment. Home buyers who own a single property, especially those with dual income, will be the least affected. Let's come back to our discussion. If you are a home buyer that owns a single property and with dual income, the impact of the interest spike means that you will have to pay extra for the interest in the next few years until the Federal Reserve reduces the interest rate. This means that you will have to cut back on discretionary spending or tap into your savings to pay for the additional interest. For most families on dual income, this is still manageable as the TDSR and MASR framework introduced by MAS has encouraged prudent borrowing. Anyway, the high interest rate wouldn't last forever. This is a test of holding power as the property market goes in cycle. Those that can hold on to their property well and did not overly leverage can continue to sleep well at night. The second group will be those who own only one property but took a maximum housing loan and with unstable income. This group will be affected if their income is cut or if anyone has been retrenched. If they are on dual income, then the situation may not be too bad as the remaining party can help to finance the mortgage. However, if the single breadwinner income is affected, the family may have to tie it over using their own saving. The worst case scenario is to sell the property and move to a smaller property. Alternatively, if you are currently staying in a private property, you may wish to rent it out and use the rental to cover the monthly installment instead. The third group is those who own multiple properties with an unstable income and will be the most severely affected. They will most likely practice the sell one and buy two strategies that gained popularity a few years ago. If you happen to have a strong and stable income and had sufficient savings, no problem, you can continue to sleep well at night. However, if you have overstretched your finance to own two properties, the ultimate test will come down. Assuming you took a 1 million loan to finance each of your property, your monthly mortgage installment will likely increase by $1,500 per month per property. This means you will technically be paying an extra $3,000 in interest per month alone. If one of the property is an investment property and is being rented out, you can increase the rental once the rental contract has expired to make up for the shortfall. You will likely hit a sign of relief as the rental market is very hot now. However, the other property likely will be an owner stay property. You have to bear the burden of paying for the extra interest every month. I assume most of the sell one buy two strategies are on dual income. If someone is affected by a pay cut or retrench, it will be good to work with your bank to work out a longer repayment period to avoid any foreclosure proceedings. If that is not possible, the next alternative is to use your saving to tide over the situation. For those that over leverage to the max and have low saving, then the only option is to dispose of the property. You happen to own a good property and bought at low prices, you can even profit from it. However, if you bought high and own a crappy property that nobody wants, you may have to sell cheap, even at a huge loss. And don't forget, seller stamp duty if applicable to you. This can be a double whammy. That is why I always advocate financial prudence and always have sufficient savings for rainy days. You never know when it will come, but when it comes, you know your umbrella is there ready for you. In summary, a high interest rate environment has both its plus and cons. The cons are the higher mortgage rate that we have to pay. The pro are now is a saver heaven. Banks are giving out very attractive fixed deposit rates that you can take advantage of. The return is even better than holding on to property, I feel. The high interest rate will also affect those homeowners who over leverage. They will have no choice but to dispose of their property if they fail to pay. I foresee foreclosure to increase in the second half of 2023 with a worsening global economy. These will be advantageous for those who have the funds ready to pick up distressed property ahead. So those eagles out there, get ready to strike. As mentioned, a bonus tips here. For those that have an existing mortgage, please contact your bank to find out the last day of your lock-in period. Your bank will not contact you and will adjust your interest rate to the default loan package which you have initially signed, which obviously may not be the best rate. So please contact your bank a month before to do a repricing if you plan to renew your loan with the same bank or refinancing with another bank. Lastly, are you ready to pick up distressed property? Or are you shivering due to the higher interest rate? Share me your views in the comment section below. That is all, and please remember to click on the like and subscribe button if you have not done so. See you in the next video. Goodbye.